The silver market on 2 March 2026 represents one of the most dramatic commodity narratives of the decade, combining geopolitical shock, speculative acceleration, structural industrial demand, and regional pricing asymmetries into a single volatile asset story. With international spot silver trading near $93.41 per ounce and Indian domestic prices averaging approximately 2.94 lakhs per kilogram, the metal sits at the intersection of fear, technology, and monetary fragility. Although prices experienced a slight intraday decline globally, the broader context is unmistakable. Silver has undergone a historic surge, rising nearly 195% over the past year, reaching an extraordinary peak of $121.64 per ounce in January of 2026. Before correcting and consolidating, the current price structure reflects neither panic nor euphoria, but rather a tense equilibrium between geopolitical risk premiums and profit-taking fatigue following a parabolic rally. The geopolitical dimension cannot be overstated. Renewed military escalation involving the United States, Israel, and Iran has reshaped global capital flows. Investors seeking insulation from potential supply chain disruptions, energy shocks, and regional destabilization have rotated into hard assets, particularly precious metals. Silver, though historically overshadowed by gold as a safe haven, have demonstrated increasingly aggressive beta characteristics in crisis environments. Unlike gold, silver carries a dual identity. It functions both as a monetary hedge and as a critical industrial input. In periods of geopolitical stress, this dual role amplifies its volatility. Fear-driven capital flows combine with structural industrial demand, creating upward price pressure that is more explosive than gold, but less stable over time. The recent intraday dip of 0.43% does little to alter the broader uptrend that remains intact on multi-month basis. International pricing dynamics reveals deeper structural forces beneath the headline volatility. At approximately $93 per ounce, silver trade below silver trades below its January high but remains elevated relative to historical averages. Psychological threshold of $100 per ounce has become a focal point for traders and analysts alike. Markets are forward-looking mechanisms. If silver convincingly sustains levels above $93 per ounce, the momentum-driven participants may push it towards triple digits simply due to technical breakout logic. Conversely, failure to maintain support above the high 80s could trigger algorithmic liquidation and a retracement towards lower consolidation zones. This tension illustrates that silver is currently as much a financialized asset as it is a physical commodity. In India, domestic silver market reflects both global influences and localized demand characteristics. The national average price of roughly 2,94,900 rupees per kilogram masks significant regional disparities. Southern cities such as Chennai, Hyderabad, and markets across Kerala are commanding premiums near 3,25,100 per kilogram, substantially above northern hubs like Delhi and Mumbai. These regional variations are not random fluctuations. They are driven by cultural consumption patterns, industrial clusters, and inventory constraints. Southern India maintains a strong tradition of silver usage in ceremonies, utensils, and jewelry, creating structural baseline demand that intensifies during periods of perceived price momentum. When international prices rally, local traders in these markets respond aggressively, widening spreads relative to other regions. This pattern demonstrates how commodity pricing in India is never purely a function of global benchmark, but also of embedded socio-economic behavior. The volatility profile of 2026 underscores the speculative intensity that has entered the silver market. January opened at approximately 2,38,000 rupees per kilogram and closed nearly 3,50,000 rupees, representing a 47% monthly increase. During that rally, prices briefly touched an astonishing 410,000 rupees per kilogram, marking one of the most explosive short-term surges in recent memory. Such velocity is characteristic of late cycle acceleration, where momentum trading, leverage future exposure, and retail participation combine to produce unsustainable trajectories. February then reversed much of that turbulence, declining 15.71% and touching a low of 2,55,000 before stabilizing near 2,95,000 by month end. This sequence, parabolic rally, sharp correction, and partial recovery suggests that the formation of a new baseline rather than collapse of a long-term bull market. Industrial demand continues to provide a structural underpinning to silver's valuation. Global expansion of artificial intelligence data centers, photovoltaic installations, and electric vehicle manufacturing has intensified silver consumption. Unlike gold, which is primarily held for investments and reserve purposes, silver is irreversibly consumed in numerous technological applications. Each solar panel deployment and each EV battery configuration embeds silver into long-lived infrastructure. As governments worldwide accelerate renewable energy targets, semiconductor capacity expansion, the industrial absorption of silver constraints applies supply for investment demand. Mine output growth has not matched the acceleration of industrial consumption, reinforcing the perception of tightening fundamentals. This supply-demand asymmetry creates a latent bullish narrative independent of war headlines. Currency dynamics further complicate the pricing landscape. A softer US dollar has provided support to dollar-dominated commodities, including silver. When the dollar index weakens, commodities become relatively cheaper for holders of other currencies, stimulating incremental demand. Should the Federal Reserve pivot towards tightening monetary policy, however, dollar strength could suppress silver's advance by increasing opportunity cost for holding non-yielding assets. The interplay between monetary policy expectations and geopolitical developments therefore define the macro backdrop for silver's trajectory. Investors must evaluate not only on conflict escalation probabilities but also on central bank signaling. Technical momentum also plays a decisive role. Silver's breakout above prior consolidation ranges triggered algorithms and discretionary buying. Markets in 2026 are deeply influenced by quantitative trading systems that respond to moving averages, breakout thresholds, and volatility clustering. Once silver breached key resistance levels in January, cascading buy orders amplified the rally. During February's correction, those same systems accelerated the decline. The current consolidation around 2.95 lakhs per kilogram in North Indian markets, above 3.25 lakh in southern markets suggests equilibrium between momentum traders and value-oriented participants. Whether this range resolves upward or downward depends on the next macro catalyst. Investments access has diversified significantly, further contributing to silver financialization beyond physical bullion purchases subject to 3% GST and making charges ranging from 5 to 25%. Indian investors increasingly utilize MCX derivatives, silver exchange traded funds, and digital silver platforms. Digital applications such as those integrated with payment ecosystems have lowered entry barriers, allowing micro investments in fractional quantities. This democratization of access increases retail participation during rallies, in which in turn amplifies volatility. While ETFs provide clearer exposure without storage concerns, they introduce market risks tied to fund flows. Future contracts offer leverage that magnify downside risks during corrections. Multiplicity of instruments transform silver from a traditional store of value assets into an actively traded speculative vehicle. The narrative of safe haven demand remains central. Military strikes and escalating rhetoric involving major powers inject uncertainty into global markets. Investors seek assets perceived as immune to sovereign default or currency debasement. Silver though secondary to gold in historical safe haven hierarchy, benefits from lower price points that attract broader participants when geopolitical stress coincides with inflationary pressure, such as rising crude oil prices. The appeal of precious metal intensifies, yet safe haven flows are inherently reactive. If diplomatic de-escalation occurs or energy supply stabilizes, risk premiums embedded in silver prices can upwind rapidly. This asymmetry creates a fragile balance between fear-driven inflows and normalization-driven outflows. The resilience displayed by silver's recovery from February's low underscores market confidence in longer-term structural themes. A rebound of approximately 40,000 per kilogram from the 2,55,000 excuse me from the 2.55 lakh low indicates persistent demand absorption at lower levels. Long-term investors interpreting silver as a hedge against monetary expansion may view corrections as accumulating opportunities. However, the sharp 195% annual appreciation limits margin for error. From a risk-reward perspective, upside from $93 to $100 per ounce appears modest relative to potential downside towards the $75 to $80 range if macro conditions deteriorate. Position sizing, therefore, becomes a critical strategic decision rather than an emotional reaction to headlines. Regional pricing dynamics within India reveal additional microstructure complexities. Southern premiums demonstrate that localized consumption and trader sentiments can decouple from national averages. In markets such as Hyderabad, single-day increases of 25,000 per kilogram have been recorded, reflecting the intense local demand waves. Meanwhile, cities like Delhi, Mumbai often stabilize more quickly after spikes, suggesting greater integration with future markets and institutional hedging flows. These disparities illustrate how domestic commodity markets operate as layered ecosystems influenced by culture, liquidity, depth, and distribution networks. The broader commodity complex also influences silver indirectly. Crude oil surges above $80 per barrel amplify inflationary expectations, which can enhance precious metal appeal. Conversely, severe global growth contraction would reduce industrial demand projections for silver, offsetting safe haven inflows. The metal's dual identity creates a complex sensitivity matrix. It benefits from moderate inflation and geopolitical uncertainty, but may struggle during deflationary recessions that suppress manufacturing activity. If investors must therefore interpret silver through a not through a single lens but through an overlapping macro scenarios. In sum, the silver price environment of 2nd of March 2026 encapsulates the convergence of speculative fervor, structural industrial transformation, and geopolitical tension. The metal stands at a crossroad between continued ascent towards psychologically significant milestones and corrective recalibration following extraordinary gains. Indian domestic markets display both alignment with global benchmark and distinctive regional premiums shaped by cultural demand. The path forward depends on persistence of conflict risk, the trajectory of the US dollar, central bank policy decisions, and the durability of industrial consumption growth. Silver has evolved from a secondary precious metal into a high volatility macro instrument, reflecting the complexities of a world defined by technological acceleration and geopolitical fragmentation. If crude oil climbs to $120 per barrel, the silver market will react through several macro transmission channels. The outcome is not a simple one directional price jump. It is the result of interacting forces involving inflationary expectations, industrial cross structures, currency movements, and capital flows into commodities. The first mechanism is inflationary transmission. Oil remains the backbone of global energy costs, transportations, and petrochemical inputs. When oil approaches $120, it pushes production costs higher across almost every industrial sector. This produces upward pressure on consumer prices and reignites inflationary expectations in financial markets. Historically, when inflation expectations rise, investors rotate capital towards hard assets such as precious metals. Silver benefits because it is cheaper, more volatile than gold, which means speculative price amplify its movement. Under such conditions, silver often rises faster than gold in percentage terms because the metal behaves as a high beta version of this precious metals complex. A second channel operates through commodity index flows. Institutional funds often allocate capital to basket of commodities rather than individual resource. When oil spikes dramatically, it lifts the entire commodity complex because energy carries the largest weight in many indices. This spillover effect draws capital towards metal including silver, copper, and platinum. In practical terms, if oil rallies to $120, commodity funds increase exposure to the sector broadly, which mechanically lifts silver demand even if its own fundamentals have not changed. The third channel involves geopolitical risk perception. Oil rarely reaches $120 without geopolitical stress or major supply disruptions. Conflicts in major producing regions, such as the Middle East, tend to trigger safe haven flows into the precious metals. Investors interpret the situation as a sign of systematic instability, potential shipping disruption, and the possibility of inflationary monetary responses from the central bank itself. These, in these environments, silver often benefits from both fear driven buying and speculative momentum. Historical patterns suggest that silver reacts strongly when commodities enter a synchronized bull phase. During previous commodity supercycles, energy price surges often preceded large rallies in industrial metals. Silver tends to follow these movements because investors treat it as a bridge between the precious metals market and the industrial metals sector. From a technical perspective, if oil moves 100 if oil moves towards $120 while silver is ready trading nearly the mid 90s range per ounce, market psychology could push silver towards $100 per ounce threshold relatively quickly. Round numbers serve as magnets in financial markets. Once such levers are breached, momentum traders frequently accelerate that rally. Conversely, if silver fails to maintain upward momentum despite rising oil, that divergence may signal that speculative demand is weakening. Another structural factor involves energy transition politics. Governments facing high oil prices often accelerate green energy subsidies and infrastructure spending. Solar expansion, battery manufacturing, and electrification initiatives all require silver in varying quantities. Therefore, prolonged oil prices above $100 could structurally reinforce silver demand over several years rather than only months. Ultimately, the relationship between oil and silver is not direct but systematic. Oil shocks alter inflation expectations, currency behaviors, geopolitical risk perception, industrial energy cost, and renewable energy investments simultaneously. Each of these channels interact with silver markets differently. When these forces align in the same direction, as often happens during geopolitical crises, silver can experience explosive rallies. When the conflict, the price action becomes volatile and uncertain. If were If oil were to stabilize near $120 for an extended period while geopolitical tensions remain elevated and industrial demand remains strong, silver would likely maintain an upward bias and could challenge previous highs. If the oil spike instead triggers aggressive central bank tightening or a global economic slowdown, the initial rally in silver may fade as industrial consumption weakens. The critical point is that oil at $120 is rarely an isolated event. It signals a broader transformation in the macroeconomic environment. Silver, positioned at the intersection of monetary hedging and industrial technology, becomes one of the commodities most sensitive to the transformation. Silver doesn't produce income. It doesn't generate dividends like stocks or coupons like bonds. When the Federal Reserve hike rates, treasury yields rises, savings accounts offer higher returns, money market instruments become more attractive. Capital that might otherwise flow into precious metal begins migrating towards high yield producing assets. This shift can remove a large portion of speculative demand from the silver market. The However, the third channel involves liquidity contradiction. Rate hikes signal tighter financial conditions, borrowing costs rise, financial margins become more expensive, and leverage speculation becomes less attractive. In markets like silver futures and ETFs, where leverage plays a significant role, tighter liquidity can trigger liquidation waves. Traders reduce positions not necessarily because they believe silver is fundamentally weak, but because the cost of holding leverage exposure increases. Another factor is market expectations. Financial markets are always forward looking systems. If traders already anticipate a hike, the price impact may occur weeks or months before the official decision. In such cases, the announcement itself may not produce dramatic movements because the information has already been priced in. The largest price reactions occur when the Federal Reserve surprises markets with more aggressive policy than expected. For silver trading near historical high levels, after a major rally, a Fed tightening cycle introduces a clear strategic risk. The metal may face pressure from three simultaneous directions: rising yields, strengthening currency valuation, and reduced speculative leverage. These factors historically limit the upside of precious metals during the tightening periods. At the same time, geopolitical conditions such as conflicts affecting global trade routes or energy supplies can offset some of these pressures. If geopolitical instability remains high while the Federal Reserve tightens policy, silver may experience violent volatility rather than a simple decline. Safe haven flows can intermittently override the negative effects of the higher interest rates. Ultimately, the outcome depends on the balance between monetary tightening and macro instability. If inflation falls and the economy remains stable, rate hikes tend to suppress precious metals. If inflation persists and geopolitical tensions remain elevated, silver can remain resilient despite higher interest rates. The metal sits at the intersection of monetary policy, industrial demand, and global risk perception, making its response to Federal Reserve actions complex it further rather than linear.